Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well. Well, there you go. Good morning, folks. Good morning. Welcome along. Good to see you here. A few of the early birds up and at it, which is awesome. Brendan, good to see you, mate, as always. While things are warming up, I'll do the intros. Most of you know, though, you guys know this part of the show, but if you're brand new, if you're finding us somehow, either just joined our program, one of our clients that haven't jumped on a live before, or you may have found us accidentally, don't even know why you're here, welcome. Jason Whitten's my name, if you didn't already know. Been property investing for a little while, over the last 20 years. I just got an alert on my phone here about a banking transfer. There you go. Anyway, that's good. Watch out for scams. I'll get on with the show. Got distracted. My bank just sent me a message. Did you make a transfer? And I'm like, I don't know. Did I? Anyway, checking out. Let's keep rolling, Jason. Getting distracted here. But good to see a few of you on this morning. And welcome along. There's Alison as well. Good to see you, mate. Back in the house. Fantastic to have you here. What we're going to do today, we're going to keep going with our bit of a deep dive and into our check-in on the year. And we've done a few things. I was going to sort of do a bit of a refresher this morning of what we've gotten up to so far, folks. And then we're going to dive into something in a minute. But, we're checking in, getting started for the year. Where are you now? Where do you want to be? What's holding you back? Do you have a plan? What's going on? Have you got your team organized? That was the first catch up we talked about. We talked about some of the fundamental conversations behind the scenes. What type of strategy or what type of property and diversification strategy you might use. We talked about the proximity of profit process. We talked about the income engine yesterday. These are underneath the actual property that you buy. Some of the theories, some of the conversations around your, Brendan, some of your thoughts behind when you take action, what's going to happen, what do you need to do, and how you're going to go about it. So we've knocked that into a little bit of shape. If you haven't seen those ones, folks, pop back and watch a few of the replays of the ones of recent times. But today, ladies and gents, I thought we might dive into the 7 plans of our property investing future. The 7 plans you need to create or keep an eye on these 7 plans over your investing time frame. Now, we talk about this all the time. You guys know this. You guys know the drill. The 3 stages we kind of identify that we might be in when it comes to our property investing: the acquisition, the consolidation, our either lifestyle or legacy stage, And at any time in your sort of journey, you might be moving forward or you might be taking a step back to rearrange things to go forward. And we say, or we've got a conversation about the 7 plans. So you've got the 3 stages of your investment process, the 7 plans that need to be in play at any one time, and your 6-star team who need to help you get those 7 plans done and dusted and up and out of the way. All right. So that's the conversation today. I want to sort of take you through, and we'll dive deeper into these 7 plans over the next few days. Well, over the next 7 days after this. So let's have a bit of a look. And now, tell me in the chat, you might know the plans, the 7 plans. Put them in the chat if you do. If you don't, I'm going to go through them and we'll have a quick conversation about them as we go along. All right. 7 plans. Number 1, the first plan is the idea of, good morning, Catherine, your acquisition plan. Okay, your acquisition plan. Part of what we went through over the last few days is the idea of when you take action, what action are you taking? Where are you buying? What type of property will you buy? The property strategy you might deploy at the same time, the acquisition plan, right? Based around the capital growth or the cash flow or a combination of both that you are looking to achieve when it comes to your property investing. All right, acquisition plan, very important when it comes to being an investor, because let's face it, folks, it's all hot air and sunshine unless you buy a damn property. All right, and to be honest, unless you buy multiple investment properties, at least 3 is the statistics I see. Property investing is not going to work as well as you might think if you don't get at least 3. We say 5 to 6 is a good number over a 7 to 10 year period. That's kind of the number that gives you an opportunity to get good momentum. Probably there might be 1 or 2 duds in there or lemons that you sort of purchase and then it's not really doing its thing. You thought it was and then it doesn't. You know, nobody's immune to, you know, something not going perfectly to plan. So if you buy 1 and it doesn't go to plan, then you're like, shit, that's 100% of what I've done. If you buy 5 or 6 and 1 doesn't go to plan, it's only a small percentage. 5 is what, 20%? 6 would be 15, I think, or something like that. So, you know, the percentage of risk of 1 not working goes down the more you have. I'm a bit of a fan of a little bit of safety in numbers in that sort of sense. So the acquisition plan, ladies and gents, how many properties, you know, how many properties, the dollar amount and the cash flow of those properties, you know, what is it that you're aiming for to achieve in your acquisition plan? Okay, not that down pat. Now, what we will do in 7 days is we'll talk about these acquisition plans, or where these 7 plans land in, and sometimes they and showing that my internet sort of fell in and fell out. So let me know I'm still, you're still with me, but I'll anyway as we go. Right, the second one. Right. Now, lending is interesting. It's important as well because sometimes your lending plan is different at different stages. Plan in the acquisition stage, the buying stage, and here, or the borrower have access to your capital and your equity is different to lending over here. Well, not necessarily different, but there's different reasons and different styles of loans and different lending behaviors. Okay, so the lending plan, what is it? You know, are you structuring your lending for maximum borrowing and you know, you're going to put a bit of money in because it's all about the purchasing of the properties and the cash flow is not the issue? Are you structuring your lending for aggressive debt reduction because, you know, you've bought a few properties and now you need to really, you know, debt reduce that non-deductible debt? What might it be, right? You know, are you structuring your lending so it gives you the best upfront cash flow and buying and servicing, interest only on every loan for 5 years at least, so you can get the borrowing going, and then you might do another 5 years and then you'll do P&I afterwards or something like that, right? So folks, what is your lending plan? And obviously your lending plan would change as you go along, but you've got to have one at the start to get rolling, and then adjust it as you go along, okay? So, loan to value ratios, interest rates, terms, how long is the loan, P&I or interest only, et cetera, okay? Those things are pretty important to really sort of get dialed and make sure we understand as we go along. Some the next couple of ones is property management. So the person is going to spend help you. Put it in the chat for me, folks. How do they help you? For most investors, keep it safe. Paint numbers for the legislation and all that. But at the end of the day, not only at the end of the day, keep bring cash flow over time, help maintain the property in a way that the property grows in value. Okay, so that's what we're wanting our property manager to do. How do you plan with a property manager, and what do they get up to, and all sorts of things? Pretty important to have dialed. And that property management plan, might extend over 15 or 20 years. Sam talks about the sort of the 15-year, every 12 to 15-year rejuvenation of each of your properties. Bring the property up to speed so it can still compete in the world of rentability and maximize your rental income. Okay, so part of your property management plan is to say, all right, next year I'll replace the carpets, and in 5 years I'll replace the bathrooms or whatever. Okay, so how do you put that into your plan as you manage your properties as you go along, folks, and dive deep into that. All right. One of my favorites, folks, is a tax minimization plan. Tax min plan. All right. Tax min plan, where as property investors, there's a number of taxes and duties that we're exposed to. And for us as property investors, we have to understand how to navigate those. Morning, Fritz. We have to understand how to navigate those, folks, and minimize them legally. Don't break the rules, use the rules to get you what you need. Okay, get you what you need. Because for most property investors I sit down with and our coaches sit down with, it's not the challenge of you don't have enough. It's often you're not doing the most or the best with what you have to begin with, which is, our income and our equity and other things, maximizing all of those, making sure they're as efficient as possible. Okay, as efficient as possible. So a tax minimization plan, we've got to have a look at how do we minimize our income tax, how do we minimize our capital gains tax, how do we minimize, stamp duty, land tax. There is a few taxes, unfortunately, we're exposed to as property investors, or fortunately, we can manage very effectively, way more effectively than someone who is not a property investor, folks. That's just the way it is, which is another benefit of being a property investor or building a property investment portfolio. You get access to some things that other people don't in that space, all right? So we're minimizing our tax. Another plan that needs to be in place. And sometimes it's in place right from the start. Sometimes it's a 2 or 3 or 4 stage plan. Is a plan to reduce debt. Debt reduce, right? So, over here in our sort of, 3 stages, your values of your property and rent might go up over time. Let's call this 20 years. 20 years. And your cash flow might be negative, but over time, because the rents go up and the debts go down, that's the debts. And this is kind of the distance here, negative cash flow potentially. You might need to negative gear that, positive cash flow after tax, et cetera, right? Over here becomes where, the cash flow is good. Now, what happens if you go ahead and go, all right, well, maybe I will, I'll start here, but I want to aggressively reduce that debt, okay? And then, you bring your cash flow opportunity back closer. Your rents and growth go up over time. You can accelerate those by doing things like, we talked about it yesterday, furnishing your property and, adding value and stuff like that. But what else can you do? There's some things you can control, which is, aggressively reduce the debt if team, it's part of your plan. You don't debt reduce at the cost of buying the properties, okay? And that's something that you talk to your coach about. So, again, we'll dive into that over the next bit, but debt reduce, all right? When is it? When is the best time to reduce the debt? And what debt do you reduce? Because you don't reduce non-deductible debt, folks. As a priority, you reduce bad debt, debt that doesn't create an income, debt that's not tax deductible, because it's not doing you any favors, folks, is it? It's not doing you any favors as you go, right? Number 6, and it's not necessarily in any order, folks. And sometimes, something like a financial plan. Caught up with a client the other day. Now, she's just turned 60. So her number 1 plan is her financial plan back here, which leads all of this stuff. Often it's either an acquisition plan or a financial plan that's kind of the leader, the driver of what we're doing. And then the other plans kind of subserviate. I don't know if that's even a word. Fit into either the acquisition plan or the financial plan, or a little bit of both, okay? So the fin plan, and a lot of financial plans, a lot of people, I've got a financial planner and I bought some life insurance, well, that's not financial planning, folks, let me tell you, but I won't get on my high horse today. Financial planning is about cash flow and asset and tax and insurance planning over a 20 or 30-year period. How do you transition from owning a bunch of assets and having a job to drawing an income from, tax-free sources, tax-free places, and making sure all of your assets are in the most efficient place? How do you do that? And an accountant doesn't, it's not their specialty. And the right financial planner knows how to do that and is the right person to talk to. So there you go, Catherine. Okay, that's what you might need. Yep, perfect. Okay. And last but not least, what I call an acceleration plan. An acceleration plan. An acceleration plan. What happens, and some of you might not believe this because you're at the start of your journey, after, 10, 12, 15 years, the equity that you have in your, you get this problem. You get this massive problem, which is an awesome problem to have. It's a brilliant problem to have. You have a huge amount of wealth that's so lazy, it's not funny. It's not creating enough for you. It's just sitting there on the bank's balance sheet, on your assets register, but it's not creating enough income. It's not accelerating the debt fast enough, okay? Or not accelerating your wealth fast enough. And the acceleration plan, the wealth acceleration plan, this is where, we talk about things. You guys have seen this, we've done this before. We talk about things like, joint ventures, small, developments, other types of deals where you might accelerate some of your wealth by creating trading activity or higher return activity, because you can take a little bit more risk in the world of investing. Because, if you lost 50 or 100 grand out of 4 million, it's not the end of the world. If you lose 50 or 100 grand and you've only got 150 grand, that's a damn lot, folks. So, it goes to the risk profile. Okay. So there's the 7 plans, and we're going to sort of dive deep into each of those plans over the next 7 Wealth Coffee Chats, folks. Okay. As we go along, I'll probably start Monday. Friday, tomorrow, I'll do a little bit of a market update, I think, as we go. But that's where we're at as we go. Brendan's got a question there. What sort of negative cash flow are you seeing people carrying at the moment after the increase rate rises? Yeah, Brendan, it's not unusual to see, between 5 and 10 grand a year at the moment for negative cash flow for people putting into their property portfolio. Now, it does depend, Brendan. It does depend on 2 things. Your interest rate. Some interest rates can, at the moment, there's quite a difference in interest rates. Some can be 1% less and some are 1% higher, depending on who you are and where you're borrowing from. And the others is like negative cash flow after tax. Depends on who you are, whether you've got your PAYG tax flow variation going on, Brendan, as we go. The other one, folks, which is an interesting one, because, and I might dive into this at some point, Brendan, as well, with your properties, right? Not only, and this is where sort of advanced lending occurs, right? So let's say I've got 60% on my regular, I've got 20% on my redraw, right? And this is my actual loan. If I need to, with my cash flow, if my dollars are negative, I can take $1,000 a month out of my redraw, Brendan, and I can top up my negative cash flow by using some of my equity. So if it was $12,000 a year for this year, and because you want to navigate the ability for, navigate the interest rates, and by, mid 25, those interest rates go down 1% and the rents go up, and you'll be back at, neutral or positive cash flow. I have always used some of the property's equity to cover that if I need to. Okay, so this is kind of advanced cash flow and cash management when it comes to your portfolio. The property can pay for itself, and it just depends on where you're at, Brendan. 80% lending. You probably won't have access to redraw to do that. 70, 60, 50% lending plus a redraw facility is where you start to sort of get, that going. So reach out to your coaches. Looks like a few of you need to reach out to your coach as you go. Yeah, short-term rental for your principal place of residence for sure. Remember, you've got 6 years to, rent your principal place of residence out. Capital gains tax free as well. So remember that. And either move back in or sell it later on. So that's a make sure you chat to your coach about the strategy, but there's some great stuff in there. as you go. Yeah, Alison, the car can impact your servicing for sure. So have a little chat to your coach and your finance broker and your plans. You know, sometimes I've said to people, get your next property under your belt and then buy the car, because after that, the property doesn't affect the car purchase, but the car purchase affects the property purchase. Yeah, they'll sell a car to anyone. Well, they'll finance a car to anyone anyway. There you go. All right, team. I think we've gone over a little bit today, but listen, over the next 7 days, we'll do the 7 plans. We'll dive in, you know, and really sort of reset and get ourselves sorted for where we might be at. All right, thanks for joining me. I know the old internet was playing up a little bit today, so hopefully it didn't affect it too much, folks. But great to have you here, and join me tomorrow for another one. We'll do it again. 8:10. See you then, folks. Bye-bye.